Okay, so we have question number 4 that is related to our GS paper, our governance paper 1, and it is of 20 marks. So we are starting guidelines answer again. So here question number 4 part A is of that discuss in between enterprise risk management and its components and limitations. So we have to discuss about enterprise risk management, its component and its limitation. This question is for 5 marks. So we can easily check out that how long this answer they have written for 5 marks. For 5 marks we have to write at least 10 points. So here it is that environment risk management process is put in place by an entity, board of directors, management and other personnel, applied in strategy setting and across the enterprises, designed to identify potential events that may affect the entity and the manage risk to be within its risk appetite. So within basically with the risk appetite, they manage this risk also to provide reasonable assurance regarding the achievement of entity objectives. So enterprise risk management encompasses aligning risk appetite and strategies, also enhancing risk response decisions. So enterprise risk management, basically what it does, it aligns risk appetite and strategies and enhancing risk response decisions, reducing operational surprises and losses, identifying and managing multiple and cross enterprises, seizing opportunities, improving deployment of capitals. So enterprise risk management consists of 8 interrelated components. These derived from the way management runs an enterprises are integrated with the management process. These components basically are internal environment, objective setting, event identification, risk assessment, risk response, control activity, information and communication, and then monitoring of this, and then monitoring. So these are all the components for enterprise risk management. So enterprise risk management is not strictly a serial process, but where one component affects only the next. It is a multi-directional iterative process in which almost any component can thus influence another. So enterprise risk management is not only basically a serial process, but it is a multi-directional process which in this process almost any component can thus influence another. So if one part is infected, then another part can also influence by that part. So we know that the enterprise risk management that is related to internal environment, objective setting, and event identification, risk assessment, risk response, control activities, information and communication, and monitoring of the risk. Now we have another question, that is question number 2, that is risk analysis is an essential tool that one could save time, money and reputation. I have already discussed this question and I also explained the statements bring out the use of risk analysis. If in a simple term I can tell you that risk analysis, that means if we don't have a proper analysis, how do we control it? So risk analysis is really essential for any business. So we have answer for this question is here, that is after identification of risk parameters. So after identification of the risk parameters, the second stage is basically of analyzing the risk, which helps to identify and manage potential problems that could undermine key business initiative or projects. To carry out risk analysis, first identify the possible threats, what all are the threats, and then estimate the likelihood of these threats which will materialize. The analysis should be objective and should be industry specific within the industry. The scenario based analysis may be adopted taking into consideration of possible events that may occur and its alternative ways to achieve the given target. Now the risk analysis can be complex as it requires to draw on detailed information such as project plans, financial data, security protocols, marketing forecasts, and other relevant information. However, it is not essential planning tool. One could save time, money, and reputations. So risk analysis is useful in many situations, like while planning projects, to help in anticipating and neutralizing possible problems, while deciding whether or not to move forward with a project, and also while improving safety and managing potential risk in workplace while preparing for events such as equipment or technology failure. It is important. Theft, staff sickness, or natural disaster, we need to consider all such points. Also, it is useful when we are making planning to change an environment, such as new competitor coming in the market, for change to the government policies, when all the permutation combination of possible events threats are listed, while analyzing the risk parameters and steps taken in to manage such risk. So these all are the steps and situations where we should have to analyze risk, and basically this risk analysis help in these situations. So another question is, that is, the non-financial risk do not have direct or indirect impact on business. So non-financial risk may do not have direct impact or an immediate impact on the business, but the consequences are very serious and later do have a significant financial impact. So in the later stage, it can have a serious impact on the organization. So what all are the we need to consider that the list of the non-financial risk encountered during the course of the business by the business entity. So what all are the non-financial risk that have to be encountered during the course of the business of an enterprises. So this is various type of non-financial business risk that is faced by an organization. Business and industry risk and service risk. Business risk implies basically certain uncertainty in the profits or dangers or loss and the events that could pose a risk due to some unforeseen events in future which causes business to fail. Means there could be an uncertainty in profits or danger or losses. Business risk refers to the possibility of inadequate profit. Means in the business risk, first we need to consider in the non-financial risk there is a business risk. So business risk basically refers to the possibility of inadequate profits or even losses due to uncertainty. Example, for example, changes in taste, preference of customers has changed, strike has happened, increased competition, change in the government policies, obsolescence. These all are the business risk which could have a non-financial risk over the enterprises. So every business organization contains various risk elements while doing the business, as you know. So these type of risk may also arise due to business dynamics. Means business dynamics किस टाइप के हैं, competition respecting tariff prices, customers relation risk, and so on. So another we have that is strategic risk. So what all are the strategic risk that can associated with the non-financial risk? That is the business plan which may have not developed properly and comprehensively since inception may lead to strategic risks. Means these business which have not been developed properly, that can have a strategic risk over the enterprises. For example, strategic risk might arise from making poor business decisions. Means poor business decision has been taken, and from that decisions we are facing, an organization is facing strategic risk here. So from the substandard executive decisions that could happen, that could lead to strategic risk, and automatically the strategic risk could lead to non-financial risk. So from inadequate resource allocation, or from a failure to respond well to changes in the business environment, that could also lead to strategic risk, and that automatically comes under the non-financial risk. So another risk we have, that is compliance risk. Compliance risk is compliance risk can not directly have impact, but it could have a major impact over the organization, that the risk arises on account of non-compliance or breach of laws and regulations which the identity is supposed to adhere. It may result in deterioration of reputation in public eye, penalties and penal provisions. So we also have a fraud risk. Fraud risk is basically related to fraud is perpetrated through the abuse of system, controls, procedures. Working practices also comes under the fraud risk. Means if someone is doing wrong working practice, that could also lead to fraud, and that fraud will lead to non-financial risk to the business. So it may be perpetrated by an outsider or insider. It could be done by any party. Fraud may be useful, detected immediately, and thus the detection should be planned for on a proactive basis rather than on reactive basis. Also, we have a reputational risk, transaction risk, disaster risk, regulatory risk, technological risk. So reputational risk, we know that if any this type of a risk from a negative public opinion, such as type of a risk, it could also lead to business failure. Then we have a transaction risk that may arise due to failure of inadequacy of internal system information channel. So for transaction risk, we have a internal system inadequacy, also information channel inadequacy, employees integrity could also lead to this transaction risk and operating process. Now we have a disaster risk. Any natural calamity can also lead to non-financial risk. Fire, earthquake, man-made risk due to extensive exploitation of land masses. They are basically telling their reason. Also regulatory risk on account of a change of government policies. Government policies can also change here. I have also given you example of Vijay Mallya here, Kingfisher Airlines. And perception, especially this type of risk is associated with the food and beverages and pharmaceutical industry. But we have a live example of Kingfisher Airlines here. So we have a technological risk, that is failure of systems caused due to tampering of data access to critical information, non-availability of data and lack of control. So non-availability of data is also could lead to technological risk that could automatically hamper to the organization. Now we have another question, that is question number 4 and last topic of this lecture, that is what do you mean by handling of risk? How do we handle this risk, and explain the risk retention as a method of handling risk. Means risk retention, that all those risks which we can retain. Some risk we can retain and some risk we have to avoid. So where that is handling of risk refers to responding to the risk situation, that how we are responding the risk situation when the risk actually materialize. For handling the risk, first the ownership of the risk should be allocated, and responsible for the personal handling the risk need to be identified and assigned. The person concerned should document the risk when it arises, report to the higher basically higher authority they are talking about, higher position they are talking about, in order to have risk mitigation measures and later to minimize the risk. Risk retention, as we know that the risk retention, when we can retain such risk that would not have such negative impact on the organization, that is, and it is an handling and unavoidable risk internally. So basically unavoidable risk internally, and the firms bear absorbed due to the fact that either because of insurance could be purchased for such type of a risk, or it could be too expensive to cover the risk and much more cost effective to handle the risk internally. Means cost effective it is very nominal for an organization to handle such type of a risk. Usually retained risk occurred with a greater frequency. So we can retain risk greater frequency but have a lower severity. This line we can ignore such line. So we have that, like in insurance, deductible is a common example for risk retention to save money, since a deductible is a limited risk that can save money on insurance premium for larger setbacks. There are two types of retention method for containing losses as under. We know that the active risk retention, passive risk retention, where the risk is retained as a part of deliberate management strategy. Means it is a part of deliberate management strategy after consciousness evaluation of possible losses and causes. That is, that risk is retained as a part of deliberate management strategy. Means management strategy is a part of it. and we have a passive risk, that is where the risk occurred through negligence. Passive risk is through the negligence. Such type of retaining risk is unknown, and because of the risk taker either does not know the risk or consider it a lesser risk than it is actually is. So passive risk is basically due to the negligence of some person, and if we talk about risk retention, that is through the that risk retention through the deliberate management strategy is a part of this active risk. Now we have another question, that is part 5 related to compliance, and then we have question number 6 that's related to ethics. We'll finish it soon. Bye.